Welcome back to Snowball. I'm Jim Cosmas. I'm going to go over with you today the break-even calculation tool. Now, why do we need a break-even calculation? Well, in order for us to price our services correctly, in other words, our repair pricing, our replacement pricing, if we do replacements, in order for us to be able to price those correctly, we need to know what our true break-even is. You see, there's no method, certainly no effective method, of pricing our services and our replacements correctly unless we know what our true break even is. So without further ado, I will share this break even calculation tool here with you and go over maybe a sample company and show you exactly how to come up with the break even. So I'll share my screen here and we will go through that right now. Okay, so what you're looking at here is the break-even calculation tool. Now, you will need some data in order to effectively fill this spreadsheet out. So most of the data that you're going to need is, in fact, all of the data you're going to need is going to come from your financials. So if you pull your financials, I would pull your financials to show percentages as well. And you need to have 12 months of financials, a 12-month either 12 months year to date or the prior or fiscal year, pick last year. What you're going to need here in this first box, by the way, anything in blue, all of these boxes in blue are boxes that you can fill in that require some data, some information. So you will look at your 12 months of revenue. This is top line revenue. Now you could look at last year's revenue, 12 months, or you could look at a 12-month run rate. Now, what do I mean by a run rate? A run rate is we're going to look at a 12-month block of time. Doesn't necessarily have to be last year. So it can be this month and then back 12 months. So we're looking at a block of time of 12 months. If you want to do this for fewer than 12 months, you could, but then you have to put in some other calculations. So I would do 12 months if at all possible. So put in 12 months. We'll put in a sample company here. And this particular company is doing $2,437,528. Okay, I'll say that's what this particular sample company did. Percentage of revenue from replacements and percentage of revenue from service. If you don't have that broken down, then just put everything under service, put 100% under service. In this particular case, we're going to say that 70% of the revenues come from replacements and 30% of the revenues come from service. Now, if you're doing plumbing or electrical or even any other trade, HVAC service, there is a separation of replacement and repairs. You may not have it separated like that in your financials. So look at it more like this. If we're doing the service calls, the repairs, something's broken, I went and fixed it, that all falls under the repair bucket. If we have larger ticket items, like we're replacing a panel, we're installing a generator, we're replacing a water heater, we're installing a water filtration, maybe we're installing a roof versus repairing a roof, right? These all fall under the installation bucket, and you should count them separately. Now in this box here, we're going to put in our target profit, not our actual, our target profit. Where do we want to profit? And we're going to say in this particular case, we want to be at a 20% profit, right? Total profit for the company. Now here's where we need to look at our financials and come up with our cost of goods sold, our COGS. These are our direct costs, and direct costs are anything associated with the field work that we do, with the jobs that we do. Now, there are a lot of schools of thought of what goes into cost of goods. We've come up with what we know must go into a cost of goods. Here are the list of those things. One of those things is materials. So materials in this case, we'll say are 13%. Now, don't get hung up on these percentages. This is not to say that this is what you should have. This is just this particular company in this particular scenario. So don't get hung up on 13% or any of these percentages. This is just, again, for the purposes of this exercise. Equipment now, we'll say in this case is 22%. What's the difference between equipment and materials? So materials are going to be the bits and pieces, right? The service parts, the repair parts, the parts, the components, those are materials. Equipment is just that. So if we're replacing a heating and air system, we're replacing the furnace, the air conditioning, the coil, the air handler, whatever. If we're replacing a water heater, obviously a water heater, a generator, a panel. The larger items, a system, is all falls under equipment. The ancillary things, all the service items and all the other ancillary parts of a replacement job fall under materials. If you don't have them broken down, then list them all at one place. If you have everything listed at materials, that's okay. Put it all under materials. It's not going to matter all that much. Total field labor, unburdened. And what we mean by this is your entire labor required in the field to perform the services, which means that this is all of your service technicians, your installers, your apprentices, helpers, your sales staff, if it's field related. Okay, all of that all goes into field labor, and we do not count taxes and insurances and benefits. All right, so total field labor, we're going to say in this scenario is 12%. Again, don't get hung up on the percentage here. Our permit costs. Permit costs are permits associated with the job only. This does not have anything to do with business permits or business licensing or any of that sort of thing. This is a permit to do a particular job. I replace a water heater, I need to take a permit, that goes here. I replace air conditioning and heating, I need to take out a permit, that's where this goes. Electrical permit, that's where this goes. So our permit cost as a percentage, we're going to say is 0.5%. Rentals, if we need to rent something, we need to rent a piece of equipment, we need to rent something specifically for the work we're doing out in the field, okay? So rentals, we'll say the same thing, we're going to say is 0.5%. And subcontractors, this is for any sub work, any work that we need to subcontract out in the field, we're going to say in this case is 4%. Again, these numbers don't necessarily represent what we should be, or any kind of KPI. This just happens to be this particular organization. Now we're going to move into the overhead side. In the overhead side, we've broken down into variable costs and fixed costs. Your variable costs will vary based on the revenues that you bring in. What I mean by that is the percentage of that cost will vary. So the higher the revenue, the lower the percentage of the cost. The dollar value may be the same, but the percentage may vary. So in any event, look at your financials and see what are you spending in marketing as a percentage. And in this case, we're going to say we're spending 6% in marketing. So of the $2,437,000, we spent 6% of that on marketing. Vehicle expenses. This goes under vehicle payments and fuel and repairs, and anything to do with vehicles goes under this vehicle variable expense. So we will say that that happens to be 6% as well. Now we will move into the fixed cost area of overhead. We're going to look at facilities. Facilities is just that, anything to do with the facility, your rent, your utility costs, your phone bills, those sorts of things. Now, these are fixed costs, so these stay the same every single month. So we don't count them as a percentage. These are just fixed costs that are the same every single month, regardless of what the sales are. So we'll say the facility costs here are $96,501. Our administrative costs. Our administrative costs is pretty much everything else in the overhead bucket, and that is our administrative staff, their pay, all of their pay, right? Our CSRs, our dispatchers, our office managers, our other managers within the organization, the owners within the organization, providing they're out in the field. So any other labor that's associated with running the business. Also, administrative stuff. We're looking at your pens, your pencils, your paper, anything to do administrative. Basically, all of your other overhead costs will go here. And we will say that in this case, we're looking at $243,753. This is annually now, right? So we're looking at the annual. And if we're looking at our financials on a 12-month block, these are the numbers you will get. These next two boxes are rarely, if ever, I don't believe I've ever seen these next two boxes calculated in a break even. This one here, this is the debt to stay current. This, you need to put a dollar value in here. What do I mean by debt to stay current? Every single month, if you may have a debt that you're repaying. So you may have taken a business loan. You may have taken other loans. This is, you may have brought in money that was not revenue that you have to repay. You may have debt that you're servicing, other type of debt that you're servicing, all right, that is required to be paid every single month. In order to break even, you still have to pay this debt. So the debt's going to come from your profitability, but we're getting into a whole financial lesson here. But bottom line is this: in order to recover and be able to pay that debt, we have to calculate that into our daily break even. So we're going to say that we have a debt here of annual debt here of $14,400. Okay. In other words, I have a debt of $14,400 that I'm paying annually, which means that every month I'm paying $1,200 a month. So no matter what, whether income comes in, whether income doesn't come in, I have debt that I have to pay back. I have a loan, I have whatever that is debt that I'm servicing of $1,200 a month in this case, or $14,400. You may not have any, and if you don't, great, leave it out. Reinvestment, another box that I rarely, if ever, see in a break-even calculation. And what is reinvestment? Reinvestment is just that. We need to reinvest in the business. We need to buy something. We know we have some purchases coming up that are business-related purchases, maybe software. Maybe I'm buying a truck outright. We're not financing it. Maybe we're doing other reinvestment type things. You can also look at reinvestment as the oops, I forgot, or oops, something happened that was unforeseen. And that could be anything. We can have a truck that failed that was just unforeseen, and we didn't calculate that in our vehicle expenses. So reinvestment is a good place to put in those types of numbers. Now, if you don't have any foreseen expenses coming up, if we're not adding to like foreseen, adding to the business structure in any case, it's going to cost money. You could leave this blank, but I would highly encourage you to put some number in here just for the unforeseen. In this case, we're going to put $12,000. Okay, we know that we will have $12,000 of reinvestment that we're going to put in here. This will not appear on your financials, by the way, at least not on your P&L, okay? And neither will your debt to stay current. So you need to know these numbers. You can pull those from your balance sheet, or if you just know the number, put it in there. Now, field staff, number of technicians, okay? Not how many you plan on having, how many do you have now? How many do you have right now? So we're going to say in this case, there are three. We have 3 service technicians. Working days per year. Typically, there are 250 working days per year. However, you may have more or less or fewer. That's okay. Put in your working days per year. Factor in, do you work Saturdays? Are there certain holidays? Like all these sorts of things. But typically, we're looking at 250 working days per year. Average hours worked per week. Again, you will know this number. We're going to say in this scenario, it's 40 hours work per week per person in the field primarily, but 40 hours work per week. And your billable efficiency number, your next box down. So billable efficiency is simply out of 8 hours a day, how many of those hours are you actually billing for? In other words, if you're paying somebody for 8 hours of work, if you're paying your technician, this is predominantly your field staff, by the way. If you're paying your field staff for 8 hours of work, have they billed for 8 hours of work? Typically, they don't, especially in service. Typically, it's not, because now you have travel associated meetings and trainings and these other things. Typical billable efficiency is 50%. Yours may be different. If you don't know what your billable efficiency is, then put in 50%. You're probably close. If you do know, change it. Now you have companies that have a greater billable efficiency. They're really working tight, and they know exactly how to control their costs. They know exactly how to control their billable efficiency. And some companies are 60, 65% billable efficiency and more. If you don't know yours, put in 50%. You'll be pretty close. Number of salespeople. If you have salespeople, great. If you don't have salespeople, that's fine. If you have technicians that are selling techs, in other words, you don't have a designated salesperson, but your technicians do sales. Now we're talking big ticket items, replacement. So if you have technicians that do sales, don't put anything in here because you've counted them in your technicians. But in this case, we'll say we have one designated salesperson. And again, working days per year, 250. Yours may vary. So here you will see on the right side, there's an analysis that happened. And the analysis shows some numbers that we need to be aware of. The analysis shows us that we have a break-even total cost of goods is 52%. And this is the value of that total cost of goods. Our total variable cost is 64%, and this is the value. Again, don't get hung up on these percentages. These are not where you should be. This just happens to be this particular company's scenario. Okay, so we can talk about variable costs and fixed costs and whether that's too high or low in a different segment. But for the purposes of this exercise, this is what it is. Our total fixed costs of $366,000 and our total annual break even. For this company that did $2.437 million, in order just to break even, you need to bring in $1,926,671.92. Now that break even takes into consideration these critical numbers, your debt to stay current and your reinvestment. Okay, so you will, if you just break even, continue to be able to service debt and continue to be able to handle the reinvestment dollars. Our billable, our annual repair sales break even just for repairs. Okay, if you have broken it down here, repairs requires or service requires $578,000. Our replacement side of the business, in order to break even, we need to bring in $1,348,670. Again, if yours may be different, that's okay. But in this scenario, this is where your break even is. If your service is higher, put in a different percentage. If your replacement is higher or lower, put in a different percentage. This will change these. Your daily break-even goal for service. Every single day in this scenario, your service division, in order to break even, needs to bring in $2,312 every day, the service division as a whole. Every day, in order for to break even, your replacement division needs to bring in $5,394, okay? Your replacement division every day. Here are your critical numbers. The first number is your billable hourly rate with profit. In other words, how much you will bill every single hour that you bill in order to achieve your minimum, your break even, and the profit that you've put in here. In this case, we said 20%. So in order to this is the number that you will use for all of your services. So this is how you price your repairs. This is also how you price your replacements. Your billable hourly rate will be $231, whether your time and material, whether your flat rate. This really more applies to flat rate, but it does apply to T&M. And so this is the number you will use. This is your daily service goal with profit. So every day the service division needs to bring in $2,774 in order to achieve the break even plus the profit. Every day, your daily service, each technician in this case needs to bring in $924.80 per day to break even and make a profit based on the profitability, based on the number of technicians we put in here. So again, overview, your billable hourly rate should be $231.20 in this case. Your daily service goal in order to cover expenses and make a profit, $2,774. And your daily service goal per technician in order to cover expenses and make a profit is $924.80, which means that annually your service division must bring in $693,601. Your replacement division, your daily goal for replacement, $6,473. That will cover your break even and also give you the 20% net, 20% profit. And because we said we had one salesperson, that salesperson will be solely responsible for bringing that revenue in every single day. Which means that annually, we have an annual billing of $1,618,404 for our replacement division. Again, don't take these numbers as where you need to be, where you're supposed to be. This is the example that we're showing here for this particular company. You can put in whatever net profit, target profit you want. You can put in your replacement versus repair percentages. If you don't know, take an educated guess. Try to at least break it down in some capacity, because if you don't, this may skew this number quite a bit. And there you have it. That is your break-even analysis tool. And if you have any questions on that, or you need additional help, or you need to get a little further into where your numbers should be, we can certainly have a conversation about that. Reach out to us here at Snowball, and we can certainly help you. Have a great day.